Right, hello everybody. Welcome to today's Trend Signal Trading Podcast. My name is Adrian Jerry. I'm the head of trading here at Trend Signal, and I'm joined today with our chief analyst Jerry Miller.
Hello.
Hi, so it's the 16th of March 2020, and the proverbial continues to hit the fan, really, shall we say. Today we're going to be talking about the central bank intervention, we're going to talk about the stock markets in relative freefall, and we're going to talk about something called limit ups and limit downs. What on earth are they? Well, we're going to find out in a minute. But Jerry, why don't you kick us off with what on earth is going on again? It feels like Groundhog Day a little bit.
Yeah, it's just more of the same, really. Some extraordinary moves. We've rather got used to hearing about a 10% move, a 14% move, a 12% move. Last Thursday, when the markets completely missed a beat, some of the moves were just off all records, even from the great financial crisis. For example, the DAX FTSE closed down, I think, was at 10 or 12 percent, I should say, on Thursday. The CAC was about 12% down. The MIB, the FTSE MIB, which is the Italian stock index, and you can imagine anything connected with Italy at the moment, with being the centre of the pandemic in Europe and globally, really, that was down 17%. So you're close to having a bear market move in one day.
Yeah, that's horrific.
Yeah, it's horrendous. But yeah, big moves everywhere. Equities and bonds, obviously, but commodities, even foreign exchange, which normally don't have that too big a move. You know, you've got the likes of sterling crumbling against.
Yeah, that was a massive drop off in the last couple of days.
Well, there's some bad numbers that came out that suggest things are probably going to be difficult having left the EU. This was even before the coronavirus. So, but there's a lot of people dumping sterling because it paid a bit of interest, but no more. So that's one of the big sort of impacts we had on Sunday night. So last night, another intra-meeting cut. So that's the second intra-meeting cut in interest rates from the US. And none of that, it didn't even happen in the great financial crisis. Just a most extraordinary thing going.
So that's two cuts within the boundaries of the normal regular meetings, monthly meetings or whatever they are.
Well, we had another FOMC meeting, so that's the Federal Open Market Committee. That's the committee that sets rates for the Federal Reserve. That's the US Central Bank. They were going to do that on Wednesday, but they pushed it, they did it over the weekend. And on Sunday night, Jay Powell announced a cut of 1% to zero. It's zero, they do it in a band, and they keep the Fed funds rate at in a band of 0.25%. So their new band is 0 to 0.25%. So we've now had interest rate cuts of 1.75%.
That's unbelievable. I mean, the page that we're showing up at the moment is the countdown page from the CME group, so it's a little bit out of date because it's saying the current rate's at 1 to 1.25, which of course it isn't now.
No.
So they'll update this at some point. But
yeah, and most people expected the Fed to cut rates by about 0.75% on Wednesday. What they've done is they've cut it by 1% yesterday, and they've used. I mean, it is the big bazooka. I mean,
they kind of throw everything at it.
Yeah, they announced.
And there's a big asset repurchasing as well.
700 billion. It is huge, absolutely huge.
And what's happened today? We've gone limit down.
This is the irony. So we had a massive move back up on Friday when Donald Trump declared a national emergency over coronavirus. And the reason why the market enjoyed a bounce was, first of all, it was a little bit stretched on the downside, but it also means that there's a lot of federal funds that are released to tackle the whole outbreak. So it's sort of deemed to be quite positive, and as everyone was short, you saw that massive move, and it turned out it was the biggest rally in US stocks since 2008.
Yeah, that's unbelievable, isn't it?
And this is when we're all, didn't even realise it was happening. But of course, you get used to checking the markets at 9 o'clock, but of course they shut at 8 o'clock on Friday, and I was thinking, wow, they're not really doing much now at 8:30, but of course they're shut. But it just goes to show you, that was then, but of course now's now. We've had the rate cut, we've had cuts in the Reserve Bank of New Zealand, had emergency cut over the weekend as well. Bank of Japan, they've added more liquidity. No point cutting rates there because they're minus anyway. But central bank coordination to help free up liquidity and to let the markets know that they're on their side. But the market's response is, so what? That ain't going to make me well.
I mean, this really is not to get people out spending again. It's to keep companies afloat.
Correct.
Isn't it basically?
Yeah.
So to free up lending, so that companies can, I guess, weather the next month or three or whatever it may be for their balance sheets basically, and keep themselves alive.
I don't think it'll necessarily save businesses, of course, but they can only do what they can do.
I suppose the problem is, if what you're having to borrow is significantly more than what profitable in a year, typically, all you're doing is kicking the can down the road, because at some point you're going to have to pay that borrowing back, aren't you?
Yeah.
Because if you're a really low margin business, then it's not really going to help you.
It's going to be
It's deferring the inevitable.
Yeah, it is. It's going to be very, very tough. I think it needs fiscal action, so that's action by governments. And whether there's going to be this sort of largesse payroll taxes in the US, it's the sort of thing they should do here. Is maybe just sort of say, write them off for a month. I don't know. A lot of airlines are talking about making staff take unpaid leave, but we need these businesses to survive, because in 3 or 4 months' time, this will be over. But if the businesses aren't there, you don't have a job to go to.
We've got a huge other problem then, haven't we? And that's just fueling a recession, isn't it? Ultimately.
Oh, well, any dip below 2% growth in the global economy means a recession. So it's just almost inevitable that there's going to be a recession. When you look at the Chinese numbers overnight, Adrian, look, just have a look at the industrial production numbers. It's just the most extraordinary number. And the reason why this is extraordinary is that it's produced by the Chinese state, and they tend to always hit their forecast. So they will put out what they're forecasting, and lo and behold, they always hit it. Minus 13.5%. You should see how that looks compared to previous months.
Yeah,
it's horrendous.
That's quite stark.
But they did counter it by saying they thought it would be temporary. Well, I could use a phrase I wouldn't want to use on the podcast, but that is obvious. But the fact is, it's minus 13. There's been an absolute shutdown in China. And that's the reason why we can't get that hand gel, the antibac hand gel, because all the bottles are made in China. Not the fluid, the actual bottles to put the bloody stuff in. So anyway, pretty horrendous moves from in China. But obviously the whole thing is now, the epicenter of this coronavirus is in Europe. And what's interesting is that it's significant in Italy. It's moved to Spain, and the infection rate up there has just gone through the roof, and in France. I think as an island, the UK is sort of in a slightly different position, but I think it will follow the same trajectory, but it might be on a slightly slower, a slightly smaller, slightly reduced scale compared to that. But what's interesting, Adrian, is there's been no coordinated response by the EU. I thought that's what the EU was supposed to do. There's been nothing that's been coordinated. Anyway, there we go. So the epicenter for the whole outbreak now is not China, it's not South Korea, it's definitely not Hong Kong, it's definitely not Singapore, it's Europe.
Yeah. Well, hence, Trump last week, he put in the travel ban from Europe, and then he extended it to the UK.
Yeah, had to.
As well. Anything else going on we need to know about? I mean, you talk about UK maybe not faring as quite so poorly, and yet the FTSE has been getting absolutely hammered. So why maybe we can explain why that might be. 'Cause ultimately, these are global companies, aren't they?
Yeah, I mean, if you look at what's happening now, I think the FTSE, what was up last time I looked, is off 9 or 10%. The DAX was 11 or 12%. Yeah, it's bounced off the lows a little bit, but look, we're still down. So 500 points, are we, from Friday night's close? I don't know where it closed on Friday night.
It closed Friday, 56. Well, this would be
600 points.
This is when the futures finished off with FXCM, but ultimately.
But the actual market, we're down about 10 or 11%. But we're no worse, we're no better. Perhaps slightly better than the DAX and the CAC, but.
I mean, where it all really kicked off was this Friday here, wasn't it? So the 21st of Feb or whatever it was. And so we're some 33%, some third off now, off those highs.
I mean, it looks like a Swiss cheese now. It's got so many holes in the chart, so it's gapped down.
And one of the main reasons for that is that the big moves here, that was the oil move, because we have such big components of BP and Shell, which were 15 to 20% of the value of the FTSE. So when they take a big hit, the resources companies take a big hit, there's a massive impact then on that.
I mean, the big irony with oil, of course, is that we're probably all getting cheaper petrol and diesel. But the irony is, what we forget is that our pensions, a lot of our pensions actually have BP and Shell in them, obviously,
Yeah.
and they're big dividend payers. So the Lord giveth, but the Lord taketh away, I'm afraid.
Yeah, absolutely. Yeah, I mean, you see oil, so NYMEX taking a bit of a leg down towards the support there. What about Brent? What are we looking at there?
Brent
taking a bit more of a leg,
yeah.
slightly lower down.
I think a lot of the investment banks and brokers are talking about prices sub 30 now. Some of the bigger banks are talking about anywhere down to $20 now.
Yeah.
And this is down obviously to a combination of the coronavirus, but remember we've got that OPEC price war. It's you've already mentioned it, but that was that previous Thursday when they met in Vienna, where the Russians said there's no point cutting production because all you're doing is playing into the hands of the US shale oil business. But actually, I think the Saudis are right. But what they've done is punching everyone now. It'll really hit the US shale oil business really badly at a time when it couldn't afford it. But none of these oil producers can afford it. Even Saudi, really.
Yeah.
But there we go.
Survival of the fittest, I suppose. They got the cheapest production, so maybe they want to get rid of a few competitors. Perhaps I don't know. Who knows? A bit beyond my IQ, to be honest.
I think that's right. That's right.
Gold has been taking a relative bashing. What's that about, Jerry?
You see, that's really interesting. Look at that. That's shocking. $150. You would normally expect gold to be a safe haven. See, I think there are two issues here. Last week, the dollar rallied.
Yeah.
Not good for dollar-based commodities.
Yeah.
I mean, it really isn't. But
so that being the case, that it's priced in dollars, so it's not just about gold movement, it's also about the value of the dollar that it's priced in.
Yeah, so if you look at gold in euros, look at gold in sterling. In sterling, gold looks really expensive. So with sterling slumping against the dollar, the price of gold was going up and up and up. So people were just selling it, here in the UK and Europe as well. And that has a big effect. But I notice you've got a quite compressed, open chart, but if you compress it, look where gold's come from. It had gone through the roof. It discounted so much bad news, but gold unfortunately suffered from the snowball effect, and it's happened before, but this was a truly unstoppable force where more and more selling begat more and more selling. And that's what we're in the middle of now, and even more today. It's just an extraordinary move.
Yeah.
I mean, remember, gold doesn't pay dividends. Gold, you have to insure. Gold, you have to pay to warehouse it. In times of trouble, sometimes it doesn't look the most obvious investment.
Yeah, if you're holding gold, it's a bit like having a negative interest, if you like, because of the costs. It's
just that. Well, you see, by cutting interest rates, you think it might help because there's a funding cost. Because you could get that money in gold could be earning interest, but it's not because it's in gold. But now you can't get it in dollars anyway because the rate's gone down to zero now. Yeah. But no, it just shows you how beaten up it is.
And what about the currencies then? What are we looking at? Same. So New Zealand dollar had their rate cut.
Yeah, I mean, all of these things are factored in. The problem is with interest rates now being compressed in all global economies, there's so little daylight between the two. You could be inclined to put money in sterling or dollars with higher interest rates, but now everything now has been compressed back to sort of zero, which means there's no daylight, there's no arbitrage. And then you just have to look at the underlying economies, and then you look at the New Zealand economy, the Australian economy. I told you I was out in Perth a month ago. That all depends on mining.
Yeah.
I mean, everything about Western Australia is all to do with mining.
So when you see those industrial production numbers and everything else, it's just a massive problem for places like Canada, I guess.
Yeah.
But really, Australia and New Zealand.
In particular, Australia, I'd say. Yeah. In particular.
So what you've got at the moment are these sort of risk-on currencies and risk-off currencies, and we're seeing massive overextended moves in those directions. So people are, but it's interesting. I mean, euro had been going up very nicely, but euro dollar really has come back the other way. So
the euro fell quite a lot last week, about 180 points or 1.8 8 cents, which is what, sort of 1.6%. And that's because there was a flight to quality, a flight into dollars. So you've got the euro buying as interest rates have been cut in the US, but then you've got the euro selling and dollar buying as people put their money into the safest place they know.
Yeah.
And that's the dollar. It's a global currency. But the dollar's falling today, the euro is rallying because they cut interest rates last night.
Yeah.
We didn't expect it then. And it's by more than expected. So they cut it by a full 1%. We were expecting 0.75%.
So what does this mean in terms of trading at the moment? I think traders, if you're day trading or even if you're position trading, swing trading, we've just got to be a bit pragmatic and a bit careful about these things. I mean, some of the gaps we're seeing at the moment, you don't really see them so much on the currencies apart from over the weekend, but the biggest gaps you're ever likely to see, and we have to be mindful of that as traders. So one of the things I'd recommend is with that increase in volatility, everybody, your stops are going to be wider than normal. So you need to cut your size to what you would normally do, otherwise you're taking on massive increases in risk, basically. So if you normally do a pound a point, let's say it's twice as volatile now, then really you're better off doing more like 50p a point or whatever. Just simply because it's just not the same market right now.
No.
And you're seeing, you know, enormous moves on the US indices. And one of the things we want to talk about today was the sort of limit up, limit down thing. We saw this a number of times last week. Let me just move through to, let's just look at a 5-minute chart. So today we're in something called limit down because we haven't opened yet on the US market. That'll open, well, normally at 2:30 UK time. It'll open at 1:30 because we're out of sync with daylight savings. But so Jerry, can you just explain what limit down is?
Okay, this comes from the futures markets. And of course the market in the US is shut. The stock market's shut. So to get a price on the US 30 or the Dow, how do you get it? A lot of brokers, they all take the price from the futures exchange. So that's where people can buy and sell where they think the underlying Dow futures, the Dow 30 stocks will be and the S&P 500. They've got rules and restrictions in the US, in fact on a lot of commodity markets, not just in the US but globally, and they're called limit moves, and these are designed to protect the market in the event of an extreme news event. So you'll get limit down and limit up moves that they're like a circuit breaker, so it means the market stops. And what's interesting is this is happening when the underlying market's not open. So what we've done is we've fallen 5% on US futures. So we're now in limit down mode. You can only buy at the offer, you cannot sell.
Yeah. So, but basically the most that we can fall on the US futures, stock index futures, is 5% until
the underlying
market opens.
Okay, the underlying opens and then we go limit down immediately. The market shuts and then it reopens and there's a new limit, and then I think it's 10% after
I think it's
that.
8%, then I think it's 13%, and then I think it's 20%.
Yeah.
I think what happens is that the whole thing is to get people to just pause for a bit of rational thought actually and stop major panic. Yeah. But when the stock market opens and all the stocks are moving, effectively what will happen is I think it's 7 or 8%. And then it will stop for 15 minutes.
That's right. Yeah.
If it goes down, then it'll reopen. If it goes down to 13%, it'll stop for 15 minutes. If it goes down to 20%, then it'll shut for the rest of the day.
Yeah. And this has a significant effect. This is on the futures. It doesn't prevent the cash market. The cash market can still trade, but without the futures market, it doesn't work. So the whole thing goes into lockdown.
The cash really should only be something that moves when the stock market is open, but of course brokers create synthetic, or CFD brokers, spread betting brokers create these synthetic markets. But the futures markets are something that anybody can trade if you've got a futures account. These are not sort of just institutional only markets. So basically we're in a situation where, last night, in the small hours last night, straight after the open, we hit that limit down level and we've not gone back above there. So you can buy it to go back up, but it just can't it'll keep banging into that floor until we hit 130, which is the US stock market open. So that being said, what is the impact that we're then seeing on the European indices? Do you want to explain that?
Okay, well, the European markets are weaker, obviously, anyway. You've got the DAX and the FTSE and the CAC. We've talked about moves of about 10 to 12% down. But there is a feeling that when the US goes limit down, the moves in the European markets are exacerbated. And what I mean by exacerbated is that US investors and traders who are stuck, unable to sell the futures, i.e. they cannot hedge their positions at all.
So they've got a risk problem.
And so they've got a risk problem. What do they do to try and alleviate that risk in these circumstances? They will sell European indices.
Yeah.
So ironically, the limit down in the US might help pause things in the US, but it actually creates more turbulence in the European markets.
Yeah, and we've seen that overextension because we've had quite a few limit moves in the last few days. We saw it to the downside. What was it? Thursday? Was it Thursday?
Yeah, last week. Yeah, we had a limit move Thursday morning.
Where are we? Yeah, there we are. Yeah, sorry, it's just so hard to spot, isn't it? So you can see here how you get that relative level of support if you're looking at the screen here. If you're not, if you're watching this, and then of course the market then opened at 130, and then the market then caught up to what its proper price should actually be. Then what we saw then is an over-exaggeration or bigger move down with Europe. We also saw this on Friday where we went something called limit up, which is unusual. You don't normally get that, but we went limit up on the 13th. So the maximum we could move up was 5%, which kind of seems a bit weird.
It did. That's exactly what happened.
But it did do it, which then led to a massive overextension to the upside in the European indices as well. So you had the DAX up like 900 or whatever it was, just really, really big moves, and then the market came in again at 130. So fascinating moves, and it's all designed to try and reduce emotional trading and panic. Funnily enough, but what it's doing is it's pushing it to our side of the Atlantic, basically, it would appear.
It's an extraordinary move, isn't it, that move on Friday? I mean, I've never seen a limit up. I've seen a limit down. You get panic selling, but you don't get panic buying.
It's funny, I read about it on Thursday, and I was like, I didn't even know they even had that. Yeah. I'm not even sure what they have it for, to be honest, but because surely going up is a good thing. But I guess it creates too much volatility, which can be dangerous.
A limit up is just as destructive as limit. So a big move up is the same problem as limit down in a way, because it can lead to excessive volatility that leads to irrational behaviour, and that's what they're trying to stamp out. But it just extraordinary moves. One thing I forgot to mention was that we're obviously all in a bear market now. All global stock markets are in a bear market. A bear market being that they've fallen more than 20% from their peak. What's interesting is the US bear market has been the quickest market ever, certainly in the US, to turn into a bear market. It only took 16 days. So we were at a record high, and within 16 days we'd fallen more than 20%.
And let's just bear in mind that we've done this in previous podcasts, that in the previous decade we didn't hit a bear market at all for the whole decade. And yet quite early into this one we've done it in 16 days. That's just unbelievable.
A lot of people ask me, where do you think it's going to go? The big problem for everyone is that professional investors and fund managers, it's very difficult to price the risk in now. When I mean price the risk in, how much is BP worth? How much is Billiton worth? How much is Royal Bank of Scotland?
Can they recover? Can their balance sheets cover?
How much is IAG worth? Yeah, it's very difficult to know. Yeah. And so that's why you're seeing such excessive volatility. We all know that this will subside in 3 or 4 months' time. But at what cost? And that's the big problem. I'm sure there's some absolute cracking bargains out there. If you've got cash, lucky you. But there's been some big pain on the streets, and again, it's not just the European markets. I mean, as I said to you overnight, the ASX, the Australian index, that fell 10%. The Hang Seng, which had been quite sort of bulletproof, that fell 4.5%. So it's everywhere.
Yeah. Okay, anything else to add? And then we can look at the calendar for the coming week.
Oh gosh, well we could keep on going on about all sorts of stuff, but no, let's look at the calendar.
Just one quick point. I mean, we talk about the recovery. I mean, it really is a bit of an unknown, isn't it? But ultimately, the real danger if businesses are put out of business, weird way of saying it, then the recovery is probably going to be a little slower than it might be, you would think, because more people are going to be out of jobs, basically.
Lot of people sort of had this idea that it was going to be a V-shaped recovery, so the letter V straight down and straight back up again as soon as the whole thing passes. But not if businesses are put out of business. So if a business goes bust, at the moment there are companies who just aren't bringing in any revenue. And they've got rent, they've got rates, they've got staff costs, they've got machine costs, they've got all these costs and no revenue. Yeah.
How long can one withstand that?
Yeah, and it's a big problem. So the question is, are we going to have a V-shaped recovery? It probably is going to be more like a U-shaped recovery. So we're probably going to bump along the bottom a little bit. I mean, I don't know about you. Would you book a holiday? Would you buy tickets on an airline in September? Wow. It'll be over by then. Yeah. Will it? But will it?
But what you don't want to do is book it with someone and the company then goes bust. That's the other thing. That's what I'd be thinking. Okay, you're ATOL protected and what have you, but it's just a bit of a faff, isn't it?
And everyone, I'm checking my insurance policies for the businesses now, just looking at what they do cover. Not that we would necessarily need any cover for it, but it's interesting. And I just wonder what hit the insurance companies are going to take on this. Yeah. Credit card companies, gosh, are huge.
That all sounds a bit doom and gloom, doesn't it? I mean, there are some positives. I mean, you were telling me earlier about the work on the vaccination seems to be forging on nicely ahead, and the problem is there's so much doom and gloom in the media. It's really, so all you see is everything really negative right now, and it's just a bit sort of depressing, isn't it? But
do you know, this is in the Far East in Hong Kong. They call this flu. It's called the Wu flu, and they've had all this stuff before. China, Hong Kong, amazingly, have just locked the place down. The number of cases there are so small, but it's come at significant cost to them. But with time gives you hope that you can get a vaccine put together. And I think there are certain rules and restrictions on what work needs to be done to produce a vaccine. With what's going on in the markets, I bet you they're going to fast track a lot of this animal testing, a lot of the human testing, and people say, oh, it's going to be next March before we get one. I reckon we'll get one well before that.
Yeah.
I mean, it won't be in time for to quell the outbreak now, but it'll be. Hopefully, we can help a lot of the elderly who are really susceptible to this.
Yeah, absolutely. Okay, so let's quickly look at the week ahead. So what don't we know yet? It's the thing, over the last couple of weeks, it almost seems like a pointless exercise going through the economic calendar, because even with interest rates scheduled, they're doing them out of the calendar anyway. So,
I think, just to put a little bit of flesh on those comments, really, you're not going to have a data release now having an impact on a market that's moving 10-12%. It's not looking at what's happened in the past or might happen in the future regarding these sort of numbers. We've already seen the effect in China with a complete cliff edge fall. And look at the number for the Germany ZEW sentiment indicator, going from plus 0.8% to minus 25.
Yeah.
It is off the edge of a cliff. Of course it is. Well, we know everything is off the edge of a cliff. Hotel bookings are down by 90%, airline bookings are down by 90%. No one's doing anything. Bars, restaurants, clubs, ski resorts, they're all closed. What do you think their bookings are doing?
Yeah, it's going to be pretty negative data everywhere. The probably most relevant thing is probably what might come out of the G7 meetings going on there.
Well, at least they've rushed to get this meeting by satellite. Obviously, they're not meeting together for very good reasons. This has been called to discuss a coordinated plan of attack to ensure that the global economy does not go into recession, or the effects are mitigated somehow. And I think there's going to have to be a massive fiscal response, and I think it might be interesting to see what governments do in the follow-up to this meeting, but it's sort of all day. What is going to be agreed, I don't know, but tax cuts of some proportion, value-added tax, sales tax, payroll taxes, all that sort of stuff.
business rates maybe.
Yeah, governments have got to make sure we're here in 6 months' time. I mean, we will be here. This is a business that is probably least affected by this, but there's some real important businesses where they have to be, goods are made at factories, services that are delivered at pubs and restaurants. You know, you can't deliver them remotely. There's no such thing as working from home for a lot of people, and it's really tough. So I hope that governments do come up with a plan to ensure that these businesses are here when this all subsides.
Yeah, absolutely. Here.
Yeah.
All right, well, I think let's call it an end to the session. Keep the wrist tight, guys. It's unusual times at the moment, and increased chances of gapping and what have you. So just please trade responsibly, and we'll tune in next time. Hopefully we'll be together. We may be working from home, who knows, but next Monday, guys, and hopefully it'll be a slightly better picture by then. All the best, everyone.
Good.